On this next page, I'm flipping into what I described earlier. This is non-farm versus household employment. Households in the green, non-farms in the purple. You can see that non-farm employment growth is still around 2% on a year-over-year basis, which if you look through history is kind of normal. But if you look at the household employment numbers, that growth rate on a year-over-year basis is down to 0. That is more consistent with a recession, and those numbers at turning points. The household numbers are much more reliable than the non-farm payroll because they just don't get revised like the non-farm payroll does.
In August, Cathie Wood highlighted the persistent potential risks associated with rising interest rates and tightening monetary policy, expressing her serious concerns about the status of the world economy. Many people worry that the U.S. economy may be headed toward a bigger recession because it is already exhibiting indications of pressure. Wood is nevertheless optimistic about one crucial element: disruptive innovation. The CEO and founder of ARK Invest explains in her most recent analysis how technologies like blockchain, robotics, and artificial intelligence may hold the key to preventing a global economic collapse as well as generating trillions of dollars in growth over the coming years. She cautions that although the Federal Reserve's efforts are still important, these disruptive platforms, which she believes will revolutionize industries and reorganize the economy, will be the real game changer. Stay till the end as we break down Cathie's insights on the Fed's next steps, the looming recession, and how cutting-edge technologies could be the key to avoiding disaster and driving unprecedented growth.
We're in election campaign season, and so there is definitely gridlock, nothing happening in Washington, except, as you see here, the federal deficit as a percent of nominal GDP is still over 5%. And this is very high if you believe that we're not in a recession. If we're in a recession, then it's more understandable. There's a lot of contra-cyclical spending during, like, food stamps and social safety net spending during a recession. But one thing we know in this campaign election season is the candidates are focused on getting this deficit down, and it's been very interesting to listen to the different ways. Some would say spending cuts, some would say tax increases, and of course we think the answer should be a combination of spending cuts and economic growth. The best way to get a deficit to GDP down is to grow out of it. And we think that after we get through whatever this rolling recession, however it finishes, and we think we're getting close to the end of at least recognizing that it's a recession and that we've been through a rolling recession for the past 2+ years. We think that growth will take over. And as you know, we're talking all the time about the massive growth possibilities associated with the new technologies that are evolving and are ready for prime time now. I think it's very interesting that Elon Musk has actually put up his hand and said, hey, I'll help with government efficiency. You'll notice what he did at X. He cut 75% of the labor force at X, and X has not skipped a beat. Now, its advertising hasn't picked up, but in terms of the actual performance, the technology performance of X, it's gotten only better. It's getting more TikTok-like in terms of its ability to use AI and surface the interests of different people. So if he can do that at Twitter, I don't think he'll be able to do that in the government, but I know that he will bring technology to bear on the government and that we'll probably see anyone leaving a government job not replaced. And I think the attrition could pick up if there are more interesting jobs, or more, I should say, more productive jobs created in the private sector. And what I mean by that, in the government, there is still a lot of, pushing of paper. There's a lot of bureaucracy, and technology and agentic AI could certainly help be the solution there. So I think that's an interesting dynamic that could do wonders to solve the bloat that we're seeing in the government sector right now.
Although August consumer prices in the United States appear to have increased just somewhat, rising housing and other service expenses have experts worried that inflation may prove to be more recalcitrant than anticipated. This casts doubt on the likelihood of any major rate decreases by the Federal Reserve in the foreseeable future. The Labor Department's latest inflation report shows the Consumer Price Index, CPI, increased by 0.2% in August, matching economists' expectations and July's figures. Food prices rose by just 0.1%, slightly less than the 0.2% increase seen in previous months. Year over year, the CPI climbed by 2.5%, the smallest increase in over 3 years, and 0.4% lower than July's annual rate. According to Cathie Wood, these figures show some improvement for the economy, which may be strengthened even more by the Fed's anticipated rate reductions. She's certain that inflation won't be a long-term problem, and Wood sees an increase in asset prices because she believes the Fed will soon move towards significant quantitative easing. Before we get back, please don't forget to like, subscribe for daily videos like this. Here's a closer look at her analysis.
You can see the yield curve had been flattening and then inverted, and has been doing so really since 08-09 in a trend sense. But you see what happens after an inversion and a move back above zero, so that short rates are below long rates. What does that typically portend? It usually means we're in a recession. You can see the shaded lines are a recession. You can see we had gone inverted. It doesn't show here. You can barely see. We inverted for a few months in 2019. And we didn't know about COVID, and we'll never know if the inversion was an indicator that a recession was going to take place. But we did end up in a recession. Here in 08-09, moved positive, we were moving into a recession. Here we were in the recession in the tech and telecom bust. We were in the recession during the S&L crisis. We were in the recession as Volcker was trying to starve the economy of money to squelch inflation. So we're probably in a recession, and we probably, by some metrics, we have been in a recession for some time. Rolling recession, I know I've been saying for a long time. Housing went down immediately and is actually in a depression. But we do think that's a rubber band stretching, and that's why we don't think that this recession is going to be that bad. It could actually end quite quickly if we get those interest rates down and get the cyclical sectors of the economy cranking again, with so many people waiting on the sidelines, especially for housing, new and existing homes. On this next page, I'm flipping into what I described earlier. This is non-farm versus household employment. Households in the green, non-farms in the purple. You can see that non-farm employment growth is still around 2% on a year-over-year basis, which, if you look through history, is kind of normal. But if you look at the household employment numbers, that growth rate on a year-over-year basis is down to zero. That is more consistent with a recession, and those numbers at turning points. The household numbers are much more reliable than the non-farm payroll, because they just don't get revised like the non-farm payroll does. Here is that revision, and so you can see the revision. This is a once a year revision in the employment rate. And you can see how big this revision was. It was over 800,000 jobs that last year, when everybody was heralding the non-farm payroll employment numbers as strong, 250-ish per month. The actual number was in the low 100s when you get through with these revisions. So again, don't trust non-farm payroll as much as the household numbers. And then here, job openings, you can see those are coming down now quite significantly. While companies are not laying off people in great numbers right now, they are not hiring. They are not hiring according to this chart. The job openings are basically disappearing. Here is the chart on personal savings. You can see what has happened in here. The personal saving rate has gone down, and it's getting close to the record lows that we saw from 05 to 07.
In conclusion, Cathie Wood dives into the warning signs of a potential recession, using the inverted yield curve as a critical indicator. She highlights that historically, when short-term interest rates rise above long-term rates, a recession often follows. This pattern has been evident in past economic downturns, including the 2008-2009 financial crisis, the tech bubble, and other major recessions. Wood thinks this downturn may not be as bad as previous ones, even if the United States may already be in a rolling recession, with industries like housing experiencing a sharp decrease. She refers to this phenomenon as the rubber band effect, which implies that if interest rates are lowered, pent-up demand may re-enter the market and cause housing and other cyclical industries to rebound swiftly. This might significantly accelerate the economy's recovery. Wood also points to labor market data, noting a discrepancy between non-farm payroll growth, which appears stable, and household employment numbers, which are flat, more in line with recessionary conditions. She cautions that non-farm payroll data is often revised, showing that initial reports of strong job growth last year were significantly overestimated. Meanwhile, job openings are declining sharply, signaling that while layoffs aren't widespread, companies are refraining from hiring. As Cathie Wood continues to monitor the evolving economic landscape, the big question remains: will the Fed act in time to prevent a deeper recession? Stay tuned for more insights into how technology and market trends could shape the future of the global economy.